Everyone, it's Monday, the 19th of January. My name is Tilan Vikramasinghe. Welcome to another edition of Monday Market Picks. Global uncertainty has certainly kicked up a gear with the US threatening to take over Greenland. We've got Iran still unresolved. Talked about Singapore's uncertainty premium. I think this week we are definitely seeing that widening and offering a significant amount of certainty when global markets are significantly uncertain. And that's going to benefit multiple sectors. One of the things that we want to talk about today are some of those key beneficiaries. We've got Krishna Guha joining us today to talk about the S-REITs and what he thinks is going to happen. He thinks that the sector is at an inflection point. We also have Hussaini joining us to discuss a buying opportunity for a stock that is down 24% in the past 3 months. So stay with me to find out what that is. We also touch on regional telcos and why Hussaini thinks that the bull run that this sector has had over the last year is going to continue. Plus, we got John Howe joining us to talk to us about a new initiation on Hock Enterprises and why he thinks now is the time to buy. Plus, we've got some new charts from our chart guy as well. But let's join Krishna first. Krishna, welcome to the show. Now, you say that the S-REITs are at an inflection point for distribution. Why is that? Hi, Krishna.
Yeah, hi Tilan. Thank you very much for having me. And once again, very happy New Year to all our guests. So indeed, your question is that why we are expecting Singapore REITs to be at inflecting point for this year. So I think the main reason is basically we are expecting distribution to grow at a faster pace than what it has been for the last couple of years. And that is why we are saying the REIT sector on average is on an inflection standpoint. So just to give the numbers for the last couple of years for our coverage REITs on average, we saw a decline in distribution by about 3.7% for last year. For this year, we are expecting a slight decline of about 0.9%. This is for the reporting season that is upcoming. For the for the 2026, for the full year, we are expecting a DPU growth of about 3.1%. So given this distribution growth trajectory, we are saying that the sector is at an inflection point.
Right. Now, I mean, you're keeping a positive view on the sector. What's driving that? What's giving you that confidence to continue with that positive view? And what are your sub-sector preference? Everything can't be equal, right?
Yeah, exactly. So I think it's again goes back to the favorable macro that we are having. So our forecast is for the lower base rates, as well as the 10-year yield is also expected to decline. For the full year, I think we are expecting the 10-year yield at about 1.75%. Currently, it is at 2.2%. So, and this comes without sacrificing much of the growth from the GDP. So, in addition, the valuation for the overall sector we see that's about 330 basis points, not too expensive, not too cheap. So, these factors kind of lead to us staying positive on the sector. In terms of subsector preference, we are continuing with what we had last year, that is commercial followed by industrial and the least preferred being hospitality. A couple of nuances. At the margin, we are slightly more positive on the office because we see some of the cyclical drivers aligning up well for the sector. So we have pretty limited supply coming up, as well as we think that demand can surprise on the upside because of the healthy activity on both capital markets as well as wealth management. Likewise, for hospitality, we are keeping it as the least preferred subsector. But what we are seeing is that the headwinds are less intense. The supply growth is tapering, and we can see the spillover on the demand side as well. So I think those are the couple of nuances that I want to highlight, despite us keeping the subsector preference unchanged from the last year.
Got it. And what do you think is going to be that big catalyst for the sector?
So I think the sector drivers are relatively unchanged. It's a combination of growth and interest rates. So I think this growth can be both organic and inorganic. So we need a favorable mix of both. Our macro forecast is for a lower rates. That I think gives us a lot of support. But in addition, the REITs have been recycling assets. And when they are recycling assets, they are increasing the overall portfolio yield, and that supports the growth as well. So I think these two dynamic has to be favorable for the sector, and this will support the overall re-rating for the sector as well.
Got it. And what are your top picks right now?
So we are going with a mix of defensive large caps and some of the small and mid caps, which are offering relatively higher yield and as well as re-rating catalysts. So among the large caps, our preferred names are a CICT, CLAR, which are defensive A-rated names. And we are also going with Mapletree Logistics, which has a China angle, but also gives a relatively better valuation, but also an optionality from the turnaround in China. Within the small and mid caps, we have Capital and Ascot Trust, which has a committed distribution. Therefore, the distribution yield is stable, a relatively better valuation and exposure to a growing segment of the living sector. And then the other small and mid caps that we prefer are Singapore-centric commercial plays, namely Suntec REIT, Lendlease Global Commercial REIT, and OUE REIT, which gives a combination of distribution upside, re-rating catalyst, as well as better valuation. So these are the topics that within our overall coverage.
Got it. Thanks, Krishna. Now I've got a audience. Krishna, before you go,
Yep.
we got one question from the audience that says, "What's your view on the merger between CapitaLand and Mapletree?"
Well, I think it has been mentioned in the press, and I think suffice to say that a lot of things have to align. But what we can say is that there will be certain synergies because I think there are significant overlaps between the two groups. But I think it is too premature to comment on the overall impact without really knowing the overall dynamics, the contours. I mean, who gets what's the pricing for the overall deal, and etc. But if it comes through, obviously, I think the REITs for both the houses will have some implication because there will be a larger umbrella of sister REITs. So how we rationalize the portfolio, that needs to be seen. But I think at this stage, it is just too premature to comment on the overall on this merger and its implication for the overall REIT sector itself.
Got it. Thanks, Krishna. We also got a question from Alex, who's asking, Trump is threatening more tariffs on major European allies over Greenland. Futures opened a bit lower this morning, but so far reaction is muted. Is there a danger of another rout a la April 2025? I think, we've seen this movie a few times before now, Alex. I think, Trump does go in with some very aggressive sort of posturing. And I think a large part of that is to kind of build that negotiation base. We saw that with China. We saw that with Middle East. And I think that's probably the same thing here as well. So we need to see, the steps that the Europeans take also in terms of actually counteracting that. But I think the markets are kind of taking a much more wait and see attitude, given the fact that there's probably a few steps of negotiation that is yet to come for this. Now let's get back to the show, and I want to bring Hosseini in here. He's talking about C, which is down about 24% in the past 3 months on margins and competition concerns. Now Hosseini is saying, is the right time to buy? Hosseini, first of all, can you catch us up on one of the major investor concerns on this stock?
Yeah, sure. Thanks, Ilan, for having me. We had several investor conversations in the last couple of weeks since our upgrade, and we see three key concerns. First is on Brazil. So in Brazil, Shopee increased the take rate, which is always taken up positively, but here they have increased the take rates where its competitors have not. So one of the confusion it has created or investor concern is that if Shopee has done it unilaterally, there is a risk that they may see a slowdown in GMV growth because its competitor remains quite aggressive. So that's one of the investor concern. The second investor concern is on the margins outlook. So if you recall that company had raised some caution on margins somewhere in September, October last year. And in lieu of fresh color or guidance from the company, investors remain a bit on the sideline, questioning that, raising concerns that potentially the margins could remain range bound over the next 2 years. That's in one of the investor concern. And last investor concern, based on our conversations, is that the pace of share buybacks is not yet known. So company announced a 1 billion of share buyback last year, but so far there is no color in terms of whether how much of that is being executed and what is the pace of the same. So those remains the key investor concerns based on our conversations.
Right. So what's changed now to have this buy call?
Yeah, so see, the stock correction had been one of the key factor, right? So the stock has corrected almost 40% from 40% from its last year's peak, and that, in our view, suggests that most of the concerns are already priced in, and that offers a very good entry point in our view. Uh, the second thing is that there are some green shoots as well. So when we do our channel checks on the ground, what we see is that ASEAN remains quite steady and its competitor Lazada continues to go down. So that creates a room that the ASEAN is heading for a two-player market, which in turn will allow or open room for better monetization potentially by 2027. Also in Taiwan, which is a another market where they own more than 50% market share. In Taiwan, what we see is that its competitor Coupang is facing multiple internal issues, and that suggests that the risk which we are seeing in Taiwan because of Coupang is, kind of subsiding. So those are a few of the green shoots. Brazil, to an extent, is a concern, but given the 40% share price correction, we think that it is way in the price now.
Got it. Now you're staying with you, Husseini. You had a note on the ASEAN telcos, and you also mentioned the very strong run in that sector last year. Do you think that can continue this year? And before that, maybe what were some of the factors that helped this sector run so much in 2025?
Yeah, sure. So 2025 was a great year for telcos, and we had seen great run up in Singtel, Thailand telcos, and Indonesian telcos. And few of the broader themes within the telco space was competitive rationality. Uh, I have to qualify that Singapore was an exception, but otherwise, in most of the markets, competition was quite rational. And as the competition was rational, and as the 5G investments are almost behind us, the capex and opex optimization of telcos as well helped. And capital management initiatives by few of the telcos like Singtel as well helped. So those are the broader themes of 2025. We expect the same themes to continue or in fact improve going into 2026. And on the competition side as well, while all the markets remain rational, all the other ASEAN markets remain quite rational, we see that the rationality could also come into Singapore as well. Singapore last year was quite intense, but on the back of consolidation this year, we expect the growth momentum coming back to Singapore as well. CapEx and OpEx rationalization should continue across the markets. And on the back of all these things, we expect around 15% earnings growth for ASEAN telcos and 20% lift in free cash flow for the ASEAN telcos as well. Leverage levels are coming down, so that also creates room for more capital management initiatives or dividend lift or payout lift for ASEAN telcos. We expect around 42% of the ASEAN telcos are potentially in a position to increase their payout ratios this year.
So quite a bit of capital returns can be expected in 2026, especially as interest rates continue to fall. So what are your topics, Hussaini?
Yeah. Our topics are StarHub in Singapore, AIS in Thailand, and PLDT in Philippines. On StarHub specifically, for StarHub, we expect around 36% earnings growth this year. And one of the key catalysts, as we discussed, is the consolidation in Singapore. Last year, the consumer revenues for StarHub declined almost 5 to 6%, and we expect around 4 to 5% rebound this year. So a big delta coming from this side. Also to note is that StarHub is done and dusted with their Dare Plus investments, and they are entering the harvesting phase this year. So a more rational competition, and given their Singapore-centric operations, as well as the harvesting of Dare Plus investments, allows us to see a 36% earnings growth. Balance sheet is in a decent shape, so there is a potential for them to raise payout ratios as well. So those factors underpin our buy on Starhub.
Got it. Hussaini, thanks very much for joining us. Now let's move on to Zuan Hao, who's initiated on Soon Hock Enterprises. Zuan Hao, welcome to the show. Can you give us a quick background on the company first?
Yes, hi Dylan. Thank you for having me on the show. So yes, we are initiating Soon Hock at a buy with a target price of 75 cents, which is about 20% upside. So to give you a quick background on Soon Hock, Soon Hock is one of the top five strata industrial developer in Singapore with 6% market share based on GFA. And they have a decade-long experience in the industrial real estate development industry. So to date, they have sold about more than 900 industrial and commercial units so far. And at the same time, they also own a couple of investment properties that generate recurring income.
Got it. And what's driving your buy call on the stock?
So actually, we have three key reasons that is driving my buy call on the stock. Firstly, it would be its strong track record in industrial real estate development, where their key competitive strength lies in adopting a user-centric approach when developing their properties and future-proofing them. So tying this with ongoing factory and warehouse industry trends, we see higher factory prices due to increased factory space demand, and we also see increased scarcity in newer, longer tenured strata developments. So I believe this will appeal to a higher end user demand and support unit sales for Soon Hock's development properties. As such, we estimate this should accelerate FY26 NPAT to about $47.2 million, which is about 38% year on year. The next reason would be its healthy pipeline of projects. So Soon Hock actually currently has two upcoming leasehold development projects with a combined GDV of about $680 million. So these are slated for completion between FY26 and FY27. So we believe this will provide about a 17% year-on-year uplift in development revenue alone in FY26 to $294 million. So this highlights their near-term profitability. In fact, one of its projects, Stella at Tampines, has been doing pretty well. So 71% of its units has been pre-sold since October 2025 last year. So additionally, Soon Hock also has acquired two freehold assets that are currently in their planning stages. So we estimate this would also have a combined GDV of about $295 million. and it should provide this, and there should be provide an additional pipeline in FY27 and 28. So this indicates a clear path towards profitability in the medium and long term as well. So notably, we expect that one of these freehold industrial assets, Senang Crescent, to be slated for pre-sales in FY27 as per management guidance. And we estimate this to contribute a PBT of 15.6 million in FY27 alone. So then lastly, I also want to highlight that the management has intentions to recommend a 25% dividend payout policy for FY25 and 26. So this would suggest a peak dividend yield of about 6.2% in FY26 and a DPS of about 3.8 cents. Furthermore, the executive chairman has also been buying back shares, totaling about 7.8 million shares with an average price of 57 cents. So this represents about 10.4% free float, and we believe this reinforces management's strong commitments towards shareholder value creation, and we maintain a positive outlook on Hock. Hence the buy call.
Got it. Thanks, Anna. So do have a look at his more detailed report in our newsletter today. Let's quickly go to what our chart guy has to say. He's got two trading buy ideas. One is OKP Holdings. OKP's double bottom breakout has started a new upcycle. So he's turning quite bullish on that. So do look at that chart and his write up for OKP. And also the second stock is Banyan Tree Holdings in the RSI has returned to above the 50 level, indicating a consolidation that is leaning more towards the bullish side. So there is more momentum behind this stock as well. So do have a look at those two as well. And then finally, before I go, I do want to remind you of our market outlook and feng shui event on the 31st of January. So about 2 weeks to go. We've got our feng shui master joining us. He'll be taking us through some of the key highlights for investing in 2026. Plus, we'll have Hock and me talking about macro and market strategy as well. So seats are limited. It's filling up fast. So please do sign up before it's too late. With that, that's unfortunately all the time we have today for this week. Thank you so much for joining us. We'll see you next week. Have a profitable trading week.